So this is where we left off last time. So hopefully you understand at this point how to move supply and demand around, what's driving them, how to use consumption smoothing, again, what to think in terms of the quantity of loanable funds that's making it across the bridge. In many ways, if the quantity of loanable funds making it across the bridge goes up, in other words, quantity, our market clearing quantity in our loanable funds market goes up, then we would have an increase in our investment line. On the other hand, if it goes down, there would be a decrease in the investment line. You should be able to say something about whether you expect the interest rate to go up or down. And hopefully that isn't overly intimidating. Hopefully it feels somewhat like old hat at this point, once you understand the different determinants of supply and demand. But of course, in the background, it's not costless for people to find each other, the suppliers and the borrowers. And so there's going to be transaction costs. And so the question would be, how do we get those nice outcomes that we draw on our graph that seamlessly and costlessly find information flowing between the borrowers and the lenders? In other words, they find each other seamlessly. And the answer here is going to be financial intermediaries. So this is not going to be a definitive list, but let's break these out. Let's zoom in, and basically we're going to talk about banks, bonds, and stock markets here. At least that's what the book talks about. What we're talking about is middlemen or middlewomen, people who stand in the middle who hopefully reduce transaction costs. If they don't reduce transaction costs, then there's no point in using them. You shouldn't use them. Just like if a middleman increases your costs, generally you shouldn't use a middleman. This is why travel agencies have gone away. So banks, bonds, and stock markets. Now, if you think back to 2009, when many financial intermediaries, large banks, Goldman Sachs, etc., were really struggling, the argument was, well, we need to protect the financial system. We need to bail these groups out. And the question would be, why? Were they reducing transaction costs? And for many of them, the answer is no. They weren't reducing any transaction costs. That's their whole reason for being, but they weren't doing it. They were actually increasing transaction costs and making it harder for people to trade through some fairly opaque mortgage-backed securities, etc. And so one of the responses that I had to the bailout was, maybe we should do it, but on the other side, these organizations, some of them should go out of business. Some of them have actually increased transaction costs rather than reducing them. So it's important as you think about these things to remember the whole point of the whole service that banks, bonds, and bond markets and stock markets serve is to reduce transaction costs. So banks, let's think about banks. How do banks reduce transaction costs? Well, one way that they do that is by lowering risk and allowing people to diversify. So instead of my investing in one, maybe I've got $2,000 in the bank, and or maybe I should say, maybe I have $3,200 in the bank now with the government check that may or may not eventually arrive. Now I could go out and find some businesses to invest in. Maybe I invest in a jiu-jitsu school, maybe I invest in a variety of things. But I'm probably going to be only investing that $2,000 or $3,000 in a few projects. It's going to, right? Whereas when I put my money in the bank lends out to a whole bunch of projects, whether it's home mortgages, or small business loans, etc. And so what that means is that I, as a depositor or as an investor, or maybe in this case, I'm not an investor from the economic point of view, I'm a saver, but I, as a saver, have sent my money across the bridge to a bunch of people. And banks, if they do their job well, help me diversify. And by diversification, I don't have all my big eggs in one basket. Some ventures will go under, but I have a wide enough portfolio that it's unlikely that they all go under. Now, obviously, this 3-month or 6-month period may put paid to that idea. Maybe a lot of businesses will go under, maybe some banks will struggle. And maybe then I will lose my whole investment. We will see. The other idea here is that banks so they lower risk and help you diversify and also save on evaluation costs. Now, we don't oftentimes think about either of these when we think about banks. We just put our money in the banks and they pay us some very small interest if we have checking, but if we have savings, they pay us some interest. Maybe with checking, they don't pay us anything. And we just sort of assume that the money sits in the bank. But it's important to remember what they're doing with that money is they are lending it out at a higher interest rate than they are paying the depositors. And that's where they make their money. They have to cover their costs of staff and infrastructure, buildings, etc., through that interest rate spread. Now, most banks have loan officers, and those loan officers are evaluating a lot of projects. So somebody wants a business loan, they go into the bank and they say, hey, I want a business loan, and they have to provide some documentation and all of that sort of thing. Now, without banks, those people could be wandering around and we would each have to evaluate the soundness of the investment. And so by having one person, or maybe there's 3 banks in town, maybe 3 people do that. That's a relatively recent thing. It used to be through unitization. There was only 1 bank in each town and oftentimes in each county, but that's a separate issue. But so maybe you go to 3 banks instead of going to 300 different investors or 3,000 different investors. Now, as I already mentioned, this is what they hopefully do. We also know that through the political process, they may have seized the levers of power to restrict entry and restrict competition so that, in effect, they don't do this. But to the extent that they generate value in society, this is where banks do that. Banks do involve risk. As I already mentioned, if a bank goes under, if it can't pay, it will default. Now, many of us are protected by the Federal Depository Insurance Corporation. Most banks are FDIC insured, which means that up to, I think now, $250,000 in an account will get compensated by the FDIC. Now, this actually, as perverse as this will sound, Federal Depository Insurance Corporation, Federal Depository Insurance, almost certainly has increased the likelihood of bank default. And you might ask why that is, and the answer is because I pay absolutely no attention to where my bank has its money. Now, historically, I would pay a lot of attention to where they were investing and what they were investing in, because if they went bankrupt, I lost my money. And so all of the depositors paid some attention to what the bank was doing. Now, if I'm insured, I don't think any of us have ever taken a look at our bank balance sheets. We haven't selected the banks that we're investing in based on their riskiness, based on who they lend to. Most of us have selected them because of convenience or because of some promotional thing where they gave out pens at a job fair or something silly, a relatively foolish reason to select an investment. But it makes perfect sense if you understand that your deposited funds are insured by the federal government, which in effect means all taxpayers. So that's how banks function. Let's think about bonds, or actually we're talking about bond markets here, but talking about bond markets requires that we understand bonds. Now, bonds may seem a little bit complicated and scary for some, but they're really not. They are just a corporate IOU. Now, I had to explain this to my students in Iraq. They said, what the heck's an IOU? And I said, it's a note that says IOU on it. And they went, yeah, but wait, shouldn't that be IOY? To which the answer was yes. But these are a corporate IOU. In effect, what the corporation has said it's going to do is it says, give us money in the present. And this, by the way, could also be the federal government or state governments or city governments. It says, give us money today. And in return, we will pay you money in the future. Now, that payment in the future could take the form of one final payment, one big balloon payment all at once in the future. So maybe we have a 10-year bond that is a zero coupon bond, or what's also termed a discount bond. This doesn't mean you're getting a good deal. You may have heard this term. Discount bonds do not mean that they are selling below fair market value or something like that. It simply means that they are a zero coupon bond, or in other words, are payable all at once. They can also be payable in installments plus a lump sum. The installments are typically called the coupons because historically you actually had to tear them off and mail them in or turn them in, and then you would get the payment. And that way they made sure that people weren't collecting more than one payment. Although in this day and age, you have coupon payments, but you almost never would actually tear off the coupon. And so you could have a coupon bond with no face value. You could have a face value coupon with no, or face value bond with no coupon. The face value is what it says for the final payment. And so you could have a $1,000 6-month 3% coupon. So in other words, what that would do would be to pay you $30 every 6 months for 10 years, and then at the end you would get however much I said, $1,000, right? These also involve risk. They involve default risk. They involve risk that the entity that you are lending your money to, or taking this promise of payment from, that you are betting that they don't default. Now, if they close their doors, you will be relatively high up the list of creditors, but not at the top. And so these also involve risk. Now, how could you reduce the risk here of investing in bonds? One of the answers is you can hire someone to evaluate the likelihood of default. Now, hopefully you also said one of the ways you could do it was to diversify. And so maybe you buy a bunch of different bonds. But let's look at a single bond. You could hire somebody to assess how likely they are to default. And what we have at present for that is ratings agencies. Now, ratings agencies in the United States, there's 3 big ones, and they're the 3 big ones primarily because they are now part of the regulatory environment. As often happens, entrepreneurs may have a good idea and serve a market niche, and then eventually things get co-opted into the regulatory environment. This, in my opinion, is clearly what has happened with the accounting profession. Accountants provided a valuable social purpose historically, providing meaningful information to corporations through managerial accounting and financial accounting. They have now become part of the government regulatory environment for taxation. And so, at least from my experience and from what I've seen, about 80% of the accounting profession at present is about jumping through government loopholes and regulatory hurdles rather than generating information that is meaningful and valuable for management. Same thing happened with the ratings agencies. There were 3 main ones, and so what we did was say, okay, if you are going to be one of these FDIC insured corporations, you can only hold AAA rated securities. Or you have to get them all rated by one of these 3 agencies. Now that's a side note. We could take that up in a money and banking class or a history of financial regulation. It is a fascinating history, or at least it is to me. Bond ratings agencies. Now, oftentimes people worry about the fact that the ratings agencies are paid for by the companies who are trying to issue their debt. Now, I normally don't worry about that. Now, people make a big deal out of that, but that happens across the board. People, right? Underwriter's Laboratory gets paid by electronics makers to assess the likelihood that their devices will cause a short or a fire. And I don't worry about them taking the money and giving a pass. Why? Because if they do, pretty soon people will stop using and trusting the Underwriters Laboratory. Same thing happens for me with board games. Right? Some of the people who review board games say, "Oh, I got this as a promotional copy, and I want you to know this so that you don't think that I'm biased." Well, I'm not really too worried about that because you might do that for a little while. You might give away ratings for whether it's board games or payment. But I think in a competitive market, it would fairly quickly come to light that you were generating little meaningful value. However, once you are required by law to get rated by one of these agencies, now I worry about that. And so I actually think the ratings agencies, the criticism of the ratings agencies in their contribution to the financial crisis in 2008-2009 is actually more of a criticism of the regulatory environment and the rolling in of the ratings agencies into the regulatory environment than it is of ratings agencies themselves. Now, how do they work? Well, I don't know how ratings agencies work. People get hired, they try and figure this stuff out. It's hard work, I'm sure. I'm sure there's some techniques. Fair enough. What I do understand is the rating system. Typically, they rate from AAA, which is the best, to D, which is really, really bad. Basically, what they're rating it on isn't whether the investment is in unicorns and rainbows or whether it gives people hugs. It's what they're rating it on is how likely is this to be defaulted on. In other words, the reverse of that would be what's the likelihood that this will be repaid. Anything below triple B minus, anything in that range from triple B minus to D are what are called junk bonds. It doesn't mean that they don't have value. It doesn't mean that you shouldn't buy them, but it does mean that they are just riskier. And somewhat arbitrary line, triple B minus and below are called junk bonds. The result of this is typically riskier companies are going to have to pay a higher interest, just like you would have to pay me more to get me to, I don't know, engage in riskier behavior generally, or you'd have to reward me more. Now here's the big three. We have Moody's, Standard & Poor, and Fitch's here, and you can find this on on Amazon or on Wikipedia or elsewhere on the internet. That's where I pulled this from. And basically here they have some slightly different rating systems. So you'll notice that Moody's is capital A, lowercase a, whereas Standard & Poor's and Fitch's both do triple A. Now this is all for longer term bonds. Moody's goes double A1 versus double A plus, and right, A2, A3, A minus, and so on. Now once we get a ways down, they diverge, right? Moody's doesn't have a D, Standard & Poor's does, Fitch's has triple D, double D, and single D, right? And again, the issue here is that anything down in this area is termed junk bonds. It just means it's risky. Now, obviously, as you go from maybe triple B minus to D, as you range in that area, these bonds become riskier, and usually you are paying even less for an established bond. So let's talk about risk for a moment. Actually, I'm going to pause this here. Actually, no, we'll do this. You can see if you can answer this. Commit yourself to something. We'll pause here, and I will come back